Hey, welcome to this week's video. In this week, we're going to talk about the current ratio and what you should know about the current ratio. You know, the current ratio really is part of the balance sheet, and the balance sheet is I would consider the Rodney Dangerfield of the financial statements. If you don't know who Rodney Dangerfield is, I'd encourage you to go and look him up on YouTube. He constantly talks about he doesn't get respect. And really that's what the balance sheet is about. It's kind of an afterthought. It's something that when you look at it, it's like, okay, I already know a lot of the stuff that's in there. Or it's historical information. In fact, it's usually skipped over and everybody moves to the profit and loss statement. And that's kind of a mistake, because in the balance sheet really is going to give you some information about how well the business is from a financial health standpoint. It's critical if you want to get a loan. Banks will look at your balance sheet, and the current ratio is one of them that they're going to look at. And it's one of the best ways to kind of just measure the trends to see how well that you're doing from a financial health standpoint from your balance sheet. So the current ratio is one of those ratios that you can use to measure the health of your balance sheet. And really what the current ratio is trying to get at is it's measuring the company's ability to pay its bills. The formula is current assets divided by your current liabilities will equal your current ratio. And current assets are things such as cash, their accounts receivable. They're really anything that you can turn into cash within a period of 12 months. The current liabilities is kind of the opposite. It's going to be things that you're going to have to pay within 12 months, such as accounts payable. It could be debt that you have to pay. It's also the amount that you'll have to pay within the next 12 months for long-term debt. And also payables such as like sales tax and payroll liabilities. The example is if you take 150,000 and you divide it by 110,000, so 150,000 being your current assets and 110,000 being your current liabilities, that would mean that you would have a current ratio of 1.36. And we'll get into a little bit later if 1.36 is good or a bad of a ratio. But in general, you want to have your current ratio to be definitely above 1. Because if it's below 1, that means that you have more obligations that you need to pay over the next 12 months than you have the ability to generate cash from your current assets. So another thing that you might hear, and sometimes banks will talk about this, is working capital. Really, it's the same thing, except you're taking your current assets minus your current liabilities, and that equals your working capital. And again, you want the working capital to be positive. But the current ratio kind of gives you a number that you can measure and compare against over a period of time. But working capital is something that you may hear as well. So in the example I gave, 150,000 current assets divided by the liabilities 110, we had 1.36 was the current ratio. And really an adequate ratio would be 1.5 or higher. Really 2 is where you kind of want to be. And that's what you should look at when you look at the trends of your balance sheet. And that is what banks will look at. Now, it kind of depends on your business, but in general, these are kind of rule of thumbs to use. So a question I often get is, well, great, if I have a current ratio higher or way higher than 2, then I'm doing really, really well, right? And the answer is yes, that definitely is good. But I would challenge you to think about, am I utilizing the cash that I have the best way that I can? Should I be investing that cash in something else to help generate more profitability in the business? But what happens when the current ratio, in our example, is below 1.5? What are some of the things that we can do to help improve that current ratio and strengthen our balance sheet? And remember, we talked about what our current assets and what our current liabilities. So really, we're going to look to each of these areas to think about what it is that we can do to improve that current ratio. So what you could do is you could improve your profit margins, and that would generate more cash. You could renegotiate some of your short-term debt and see if you can get that into a long-term debt. You can sell some assets to help generate cash as well. You could delay some draws, and you could loan the company some money temporarily to increase that current ratio, especially if you're thinking about going out and getting a loan. You might want to strengthen your balance sheet a bit. So in summary, the current ratio tells you how well you can pay your obligations. It's, as we talked about, it's important for capital. It's also important for your business to kind of see how you're doing. You want to see a trend in your current ratio to be increasing or to be relatively consistent within that range of 1.5 to 2 that we talked about. And of course, you have to have and make sure you have accurate numbers when you're calculating the current ratio. In fact, it utilizes what we call the accrual basis of accounting, and really what that means is that we're recording our transactions based on obligations of when they're incurred versus when they're paid. So you want to record your obligations when you incur them and not when you actually pay them. And the same goes for the current asset side. You want to record receivables when you deliver the product or service that you are delivering, and that way you can match your income and your expenses. So it's pretty important for the current ratio to get that right, because if you remember right, we talked about what are current assets and what are current liabilities. So you kind of want to make sure that you measure those to make sure that you have accurate numbers. So that's all I got for this week. If you like this video, it'd be awesome if you hit that subscribe button and thumbs up, and I will talk to you on the next one.